This is Converge, a podcast from Convera. Come with us as we shape the future of finance.
And we are back, and this time again live at Money2020 with our market analysts from Convera. We have representing all of the regions. Luckily enough, we have Steve Dooley, the head of market insights from the APAC region. We've got George Vesey from the UK, and we have Boris Kovacevic representing the Eurozone. A great mix of insights to bring to you all today. And given that we're recording here in Amsterdam, we really have to start with Europe first, of course. So it's a big week for the continent. Boris, let's start with you. Can you give us a bit of context as to why the world is watching Europe right now?
Yeah, sure, Alex. Pleasure to be here, of course, for the first time in person. Definitely quite a unique moment for us. I think, as you said, it's quite a unique moment in time for Europe. It's a big week for us here. And of course, we have this trifecta of political risk events coming up. We have, first of all, the ECB rate decision, which will be quite important coming up on Thursday. We also have the European elections coming up at the end of the week, which will be probably market moving in one sense or the other. And then we are waiting the deadline on the tariffs if kind of the question of will Europe impose new tariffs on Chinese imports, especially on the EV side. And when we start talking about kind of the election as a market risk, of course, it's an important topic for us. I think here at the table, I'm the only one eligible to vote at the upcoming election. And I think the main takeaway for us is that we will probably see a rise in populism, a bit in the change of the seats in parliament. I think we're expecting the biggest increase of seats compared to 2019 for the Conservative, the ECR party. But we don't really expect it to be too much of a worry for the European Union because these soft anti-European parties and the hardliners are not really expected to form a coalition, right? So they'll probably be on the outlines. But we're also expecting the Green Party to lose quite a lot of seats. And we're expecting these unaffiliated parties to gain in popularity. So you have these three splits coming up, these three main takeaways. And while we're not really expecting markets to be moved by this European election, there are, as I said, implications on the industry side. There are expectations for these green investments to be cut down a bit by the loss of the Green Party in the parliament. But also we're expecting that defense spending is going to be racked up again, which is important given this geopolitical context of rising tensions between Europe on one side and the US and China on the other.
Mm-hmm. So George, from an FX perspective, are you expecting an increase in volatility surrounding the ECB decision? And what are you watching out for in particular?
Alex, pleasure to be here. So ECB decision, we think is pretty much priced in the rate cut that's expected. 25 basis points is going to be the first cut since the ECB embarked on that tightening cycle. So quite an important moment for the ECB, of course. But as I said, markets have priced it in, so we don't expect a lot of volatility around that potential scenario. However, if they don't cut, then that's what's going to generate the volatility, although we don't think that that's going to happen. We do think the volatility will come, therefore, from the communication from the ECB, the guidance on how much they're going to cut in the future, perhaps. We've heard a lot of hawkish talk from policymakers recently, and we had a stronger than expected inflation print from the Eurozone last week. And therefore, we do think that there could be a little bit more hawkish this time round, sort of pushing back against the expectation of a July cut following this June cut that's expected. So as a result of that, we could see the euro strengthen. We have seen it strengthen over the last couple of weeks or so, breaching that 109 mark against the US dollar. So the spot market has held up well, but the options markets are telling a different story at the moment. So although the spot market has been bullish, options have been a bit more bearish, and that's been indicated by the 1 week euro dollar risk reversal. There's been the most bearish in 4 months. So we're expecting the euro to weaken on the anticipation of the ECB potentially being a bit more dovish this Thursday. But let's wait and see. It'll be an interesting one.
I see. Okay. Well, do we expect to see maybe some more cuts from the ECB this year, which is maybe why the divergence story between central banks is starting to gain traction? Does the same apply to the Bank of England?
Well, yeah. So we're expecting the ECB to cut 2 or 3 times this year. As I said, the July cut is probably not going to be on the table, given the inflation print that we've seen, but we do expect September onwards. But interestingly, the divergence between central banks like the Bank of England, ECB, that's generating the volatility or the trends that we've witnessed in currency markets recently. So the Bank of England, for example, is coming across a slightly more hawkish, or markets are anticipating a slightly more hawkish Bank of England as a result of the uptick in services inflation that the UK saw a couple of weeks back. So the probability of a June rate cut by the Bank of England dropped from 50% to less than 10%. As a result of this its policy divergence, we've seen the pound rise against the euro to the highest level since August 2022. So certainly this divergent story between central banks is starting to gain a bit more traction again, the pound sort of capitalizing on the euro as a result of this.
Yeah, just to jump in here, of course, when we talk about these political and policy divergences, I think it's important to recognize, yes, the Bank of England is expected to cut probably less than the ECB. But I think the main question here and the main focus of FX is when we, Stephen, bring you into the conversation, the RBA, right? Australia has seen inflation being higher than its peers, right? Are you expecting any move from the RBA this year? Is the RBA the only hawk standing right now?
Yeah, well, again, thanks for having me on. Australia and New Zealand potentially, because New Zealand surprised markets a couple of weeks ago at the Reserve Bank of New Zealand decision, came out and said that they're willing to raise rates again as well because inflation's too hot. So both Australia and New Zealand are going through a similar set of circumstances. And again, like a lot of what we talk about, all still driven by the aftershocks of COVID. And in Australia and New Zealand, where we had very restrictive policies around COVID, shut down immigration completely in 2020 and 2021. That caused a big demand or sort of mismatch in the labour market, and unemployment collapsed, wages growing up, and then drove inflationary wage increases. Governments tried to course correct by increasing the scale of migration, and that's just led to a further hot market because migrants tend to come in with high levels of income. They need to buy a new house. They need to buy furniture in that house. So all of a sudden, that's just really driving this sort of spiral of inflation through Australia and New Zealand. So yeah, for the moment, it looks like Oceania, Australia and New Zealand, does look to be the one of the few hawks standing. And that's why we've seen a bit of strength from Australia and New Zealand currencies over the last couple of months. And we might see a little bit more depending on how that divergent plays out over the next 6 months or so. So it's been a period where both currencies have been substantially lower, below their long-term averages, but it looks like that's correcting now.
Okay, so we've mostly talked about the macro side driving these policy decisions. What about the external drivers like China? We know that politically tensions have been on the rise between China and on one side and then the US and Europe on the other. Boris, you highlighted the EV tariff debate. Can Europe really de-risk itself from its biggest trading partner?
Yeah, I think that's a good and valid question. I think it's important to start at the beginning and set the context here. Why are we even talking about this topic right now, right? I think the main thing to know about China is that China successfully moved up the value chain over the last couple of decades, right? And China has been, for the better half of the 21st century, been kind of this pool of cheap labor and the good supply of the world, right? The world profited from this wave of globalization. However, with China moving up the value chain, China is starting to focus more on its domestic demand and starting to export these new industries that everyone wants to race in, right? It's, as we said, it's EVs, it's solar panels, it's chips, and so on. And the problem here is that for the first time, China doesn't see the world as something of a substitute. It's more in a competitive advantage with Europe and the US, right? So when we're talking about these new industries like the chips manufacturing sector, we are seeing that the US isn't really playing with China or Europe. It's everyone is on their own. That's why Biden introduced the CHIPS Act, for example, which pushed the manufacturing sector up in the US, which caused, of course, tensions with European manufacturers and China. And the problem is that China has, in one way or another, pushed this oversupply of its cheap goods to the rest of the world, which is why the Chinese exports are actually up 20% since COVID, but European exports are down 2%, right? So Europe is exporting less goods than it did 4 years ago. And of course, this is why, again, putting it into the context of this week's European election, we are expecting European tariffs on Chinese EVs to rise this week. Same applies to the US and China, right? So these tensions are something to watch. They're not market moving on a day-to-day basis, but they are definitely important for industries and international businesses to keep in mind going into the US election.
Speaking on the election there, thinking ahead to November in the US, what impact could can't believe we're having this discussion, Trump presidency have on China and the EU?
Yeah, I think it's a good one. Well, I can start with the European perspective. Maybe Stephen can come in with the Asian perspective. I think overall, we are expecting a net negative impact from a Trump 2.0 presidency, mostly because I wouldn't say that the policies between Biden and Trump diverge as much as they did a couple of years ago. But the problem is the rhetoric of Trump being much more protectionist and him trying to push this agenda of the America first. And we are seeing it play out with, for example, a potential hike of tariffs. He talked about hiking tariffs on Europe and both Europe and China, of course. And the European continent is stuck a bit between being friendly with the US, but also seeing it as a direct competitor.
Yeah.
So we see it mostly as being net negative. And it could actually boost the US dollar a bit as well. So it would have probably a significant impact on markets as well here.
Mm-hmm. So there's far-reaching implications of the election on trade and economics. What about the Fed? Would it be exaggerated to suggest that a Trump 2.0 would put the Fed's dependence on the line?
I'll take that one, Alex. No, in fact, I was reading a Bloomberg article. It was at a survey this morning, just showing that they put about 40% probability of the Fed losing its autonomy under a second Trump presidency, whereas under Biden, it's expected to keep the traditional hands-off approach that he's had. And it's important to note here why we're talking about this is because the current Fed chair, Jerome Powell, is up for reappointment in early 2026. And whoever's going to win this presidential election, Biden or Trump, will have the ability to choose the next Fed chair. And interestingly, Powell's already been governed under both presidents. And given Trump's voice's distaste for Powell after hiking against his will back in 2019, obviously Trump's unsurprisingly made it clear that he wouldn't reappoint Powell to another term.
There's been very rare time where we've had politicians in charge of monetary policy and it's turned out well. If you look at the last 50 years, the last 25 years since central banks were given independence has been the period we've seen the most stability in financial markets. And you sort of look back to the 1960s and the 1970s and the bad old days when politicians were in charge of interest rates. And of course, regardless of what was happening in the economy, they'd be cutting interest rates going into elections. And so historically, it hasn't been a positive for markets or economies to have politicians in charge of interest rates.
Very interesting. So does the same apply to the UK and the Bank of England, George? Are the upcoming elections impacting British monetary policymakers in any sense? And what do you expect from the election there?
Not to the same extent, no. But there's definitely a crossover that's been witnessed over the last few weeks with Rishi Sunak calling that surprise snap general election, referring beforehand to the fall in inflation, sort of taking credit for that, and then saying that voting for the Tory party would be voting for interest rate cuts. I'm sure what that has to do with the government, to be honest, but it goes to show that they're trying to take credit for monetary policy that the Bank of England is obviously independently implementing. But the Bank of England itself as well, it's cancelled all of its speeches ahead of the election on July 4th, so as not to get dragged into the campaign. But for me, sort of indirectly has done by doing that, because now financial markets are seeing that as a move that they certainly won't be cutting interest rates before the election. And prior to that announcement, markets were pricing in around a 50% chance of a June rate cut. And now that's pretty much a no-go, that's not going to happen according to markets. A 10% probability being priced in for that. So indirectly, I don't think it seems like the Bank of England has sort of not dragged himself into the election campaign. But in terms of the election itself and the result and what impacts it could have on markets, well, this is an interesting topic because the Labour victory would usually be seen as a negative for the pound and UK assets. But considering Labour are way ahead in the polls, we haven't seen much of a market reaction. So investors seem quite sanguine to the whole anticipation of this Labour Party victory. And we think it's for a couple of reasons. One being that the policies don't differ too much between the Conservatives and the Labour Party. They haven't really got much fiscal headroom to play with, to be honest. But the other reason being that the Labour Party seem to have or want to strengthen ties with the EU. And the pound has really suffered from this Brexit premium since the vote to leave the EU back in 2016. So this could narrow that gap that's emerged and could allow the pound to strengthen. And we do think that this is probably a best case scenario, a Labour majority, and markets seem to think that as well. The worst case scenario, we think the biggest tail risk to the pound, downside tail risk, is that hung parliament. Evidence back in 2010 when that happened, and the pound dropped about 4% in the space of a week against the US dollar. So it's not our base case scenario, the hung parliament, but it's certainly one to watch and that we're warning our clients of just in case it does occur.
I think what's really interesting over the last 10 or 15 years is what Boris was saying earlier about how this breakdown in consensus around globalization has created a lot more volatility around these elections, because previously most politicians broadly agreed that globalization was good for the global economy, and they would continue to focus on more trade, more globalization, and closer ties. But since the early 2010s, post the GFC, we've seen this disagreement over whether that's the best path forward, and we've seen that with the Brexit vote. We've seen that with the tensions between the US and China, with the rhetoric from Trump, with what Boris was saying about the rise of some of the nationalist parties in the European election. Clearly been a big change since post-GFC, where that global consensus that globalization is the best way to advance economic policy, and that we would just farm off our production to China and continue to reap the benefits of cheap labour. That's completely changed its head in the last 10 years. And that's why we go into these elections now with a lot more market volatility, a lot more FX volatility that we were used to before 2010.
I think it's also a good point just to mention, of course, with this implied rise in political uncertainty, right, as you mentioned, Stephen, we do expect inflation to be higher next decade than it was the last decade, right? Which is, I think, has important implications for monetary policy. As you said, after the global financial crisis, we were living in a low inflation, low interest rate regime. And some companies, even young analysts, have never seen a regime with such high interest rates. And going into the year, of course, everyone, given the recent bias of the last 10 years, everyone was expecting interest rates to fall, given the fall of inflation, right? But with this new regime, with inflation staying lower, but still above the 2% target, it's a valid question to ask, are central banks just happy with inflation having fallen from 10% to 3%? Or do they want to ensure their regime pre-COVID, right, of inflation has to be below 2%? Because if it has, in this new regime of deglobalization and fragmentation, this would mean that interest rates having to stay higher for longer means less economic growth and higher unemployment rates. And the question is, in this political stage that we are in, are they willing to sacrifice growth to bring down inflation? It's a really interesting point that you mentioned with politicians being in charge of setting monetary policy. I think it's a dangerous game. And it's a dangerous game to talk about, raising the inflation target from 2 to 3 or 4% when you're not at the target, right?
What else part of that story as well is what you were saying earlier about China's competitive advantage. They're not just cheap labour anymore. If you look at China, labour in China is broadly equivalent to what you see in Eastern Europe. If you look at debt levels in China, they're at the same levels as most of the Western world. They're having a property crash. They're over-leveraged. So potentially that low inflation environment we've had over the last 20 years, was it just because of cheap labour from China? Were they just sucking out inflation out of the globe? And if wages have gone back to a more normalised state, if we're not getting cheap products from China anymore, that is how we might potentially be seeing a whole new environment via low inflation. Potentially had nothing to do with monetary policy over the last 30 years. It might have just been China. And we might be suddenly facing that we've got a whole new way of managing inflation. And if that's the case, then 3% inflation suddenly gets 4 and then 5, and then we're at crisis point again. So it's going to be a very interesting period over the next couple of years as we identify what was the core driver. And you find very often with economists is that it takes 5 or 10 years to have a look back and go, oh, that was the reason. It was something completely different to what we thought.
That's so true. So let's just, for this closing point here, let's move away from politics and back to the macro world, just because I know you guys love living in it. Let's take a 1 minute apiece. Give me each your take on what is the one risk event to watch out for over the coming weeks. And I'm going to start with George, just because you haven't spoken in the longest time.
Thanks, Alex. Well, I'm bringing it back to politics. Sorry. Is the UK election. I mean, it's coming up, right? 4th of July isn't too far away. As I said, we haven't seen a lot of volatility as of yet, but implied volatility, so gauges of expected volatility in the future, have picked up. So we do expect swings to start picking up as that date draws nearer. So UK election, watch it. Watch out for the pound rising.
Okay. Boris.
Yeah, I'll take the easy route out. I guess it's the non-farm payrolls report coming up on Friday. Of course, as you know, every second podcast episode, we talk about the non-farm payrolls report. It is the most important report globally. I think that's important to recognize, not only in the US, but looking at statistically market-moving events globally. It's CPI in the US, and it's the US labor market report. And we are expecting, and it's quite an important one because the last one disappointed expectations to the downside, which started this whole cycle of investors thinking about maybe US exceptionalism is waning a bit, right? This is why the dollar has been down in May. It has had its worst month this year. And it's a valid question. Yesterday, we had the ISI and PMIs, again, disappointing to the downside. Today, we had the job openings disappointing to the downside. So I think the non-farm payrolls report on Friday will break or make the week of the US dollar.
And Steve.
Well, I'm also going to touch on politics, but only in the distance, because equity markets that are so incredibly overheated at the moment, they're prone for a sell-off. We've seen momentum indicators really hotting up over the last 3 months or so. We had that massive result and that push higher in technology stocks after that bump in NVIDIA result 2 weeks ago. So we're getting closer and closer to that potential sell-off you see going into the US presidential election. It's got to happen sometime. It'll happen at the time that you're least expecting it. And I'm not expecting it over the next 2 or 3 weeks. So that's probably when it will happen.
Well, on that note, we had a good time, and thank you guys for joining. It was great to have all our global regions represented on this special episode, and we got to do this again. Thanks, everybody.
Thank you, Alex.
Thanks, Alex.